During periods of economic transition, surface-level data often projects contradictory signals. In early 2026, the Charlotte housing market began producing a specific structural paradox. A lagging indicator from January 2026 shows a market in retreat, with closed sales dropping by 13.7% compared to the previous year. Yet the leading indicator from mid-March shows the opposite. Pending sales, the measure of new contracts, surged by 15.3%. When active contracts rise while final closures fall, standard models can misread the delay as a drop in demand, creating the illusion of a market crash. Reacting to the lagging sales figure can lead to institutional panic, but the contract activity suggests a different story regarding the market's underlying health. The 2026 data suggests a move towards structural normalization as the market recalibrates after years of volatility. Transaction volume is beginning to follow pre-2020 seasonal rhythms, moving away from the frantic non-seasonal pace of the early 2020s. This shift is largely driven by mortgage rates stabilizing between 6 and 6.6%, creating a predictable baseline for capital costs. We are also seeing an expansion in supply, though the growth is distributed unevenly across the region and different property types. To understand the actual health of the region, we have to look past top-line percentages and track the flow of the transaction pipeline itself. The primary catalyst for new activity was the stabilization of interest rates, which held just below 6% in January before moving towards 6.6% by April. This stability allowed the region's home ownership affordability index to reach 98, making a purchase mathematically viable for a larger segment of the population. Improved affordability gave sellers the confidence to list, triggering a 54.6% month-over-month surge in new inventory. These new listings represent the top of the funnel, the essential first step in the transaction pipeline. This explains the divergence we saw earlier. January's low sales figures were simply a reflection of the low contract activity from late 2025. By contrast, the double-digit jump in pending sales captures the real-time re-engagement of buyers responding to this new inventory. Predictable capital costs effectively brought supply back to the market, initiating a healthy flow through the pipeline. As the pipeline moves to the middle of the funnel, active inventory has grown by 16.5%, reaching over 10,600 units. This increase in choice has introduced transactional friction, the time it takes for a home to move from the initial listing to a final sale. In February, the average time on market rose by 28.6%, reaching 81 days. When we factor in the time to secure financing and close the deal, the entire cycle now averages 114 days. Buyers are using this extra time to conduct thorough inspections and due diligence, replacing the panic bidding seen in previous years. This friction is a sign of the normalizing market, where participants have the time for more measured asset evaluation. While the region averages 2.9 months of supply, that single number obscures the reality of different neighborhoods. We have to look at geographic stratification to see how supply is actually distributed. This map separates the Charlotte metro into its core and outlying counties. The core urban areas, including Mecklenburg, Cabarrus, and Union counties, remain supply-constrained, with under 3 months of inventory. The shift is happening in the exurbs and rural markets like Anson and Cleveland counties. These outlying areas are reaching a balanced state, with supply levels between 4.0 and 4.4 months. Location now dictates leverage. Buyers have more negotiating power in the exurbs, while urban sellers maintain more control. Leverage is also determined by the type of property being sold. Single-family home inventory remains competitive and relatively low across the region. However, townhome inventory has risen by 17.5%, pushing the supply to 3.2 months. Condominium inventory is even higher, reaching 3.7 months of supply in early 2026. This accumulation in attached housing is increasing the time it takes for these specific properties to sell. For buyers seeking immediate options and room for negotiation, the attached housing segment offers the most current leverage. This data creates a pressure test for the market. As the time to sell a home increases, we typically expect a corresponding drop in price. We can map this by comparing the expanding days on market against the percentage of the original list price that sellers actually receive. Even with a 114-day closing cycle, sellers are still receiving 95% of their original asking price. Median sales prices also remain steady, showing a modest 1.3% year-over-year increase to $390,000. Time and price are acting as a shock absorber. Sellers must wait longer to find a buyer, but the underlying asset value is not being forced into deep concessions. The metrics from early 2026 show a market moving away from the extremes of speculative booms and deflationary busts. The drop in sales was a timing delay in the pipeline, not a signal of disappearing demand. The real narrative is the uneven expansion of supply, which is shifting leverage based on geography and property type. The 2026 model is built on 3 points: pipeline delay, stratified supply, and price resilience. This era of normalization rewards sellers who have the patience to navigate longer market times with a stable valuation floor.